So this is the year-end webinar. Our objectives are to get your books ready for the year-end audit or review process. Okay. So the first thing we want to do is talk about your retained earnings. So we want to make sure your retained earnings tie to your prior year-end audited, reviewed, or compiled financial statements. If no financials, if you don't have any financial statements, then maybe you're going to be tying to your tax returns. So you'll print your balance sheet for the current year-end. You compare the retained earnings at the bottom of the balance sheet with that of the retained earnings on your audited or reviewed financial statements. So we'll do that real quick. General ledger, balance sheet, and we'll say standard. And so I guess, you're probably going to be looking for 12/31/2013 for this year end, unless you're September or something else. Second page of the balance sheet, you'll have a retained earnings number here. And this number will needs to tie into your retained earnings on your financial statements at the end of the prior year end. So that, in that context, that's going to save the auditor's time if you jump through that hoop. So if you have you can do a support call and we can help you with that as well. If you click on utilities, and we have an exceptions report that can help you with that. The changed report audit. The material, we'll cover this in the material in a little bit, so you'll get it a couple times. And what you do on this changed report audit is for your starting system date, you'll put the date that the auditors pulled their trial balance for the end of for the last year. So let's say they came in on January 20th of 2013, and they pulled the trial balance for 12/31/2012, right? So what this report will do is it'll give us all the transactions dated on or after the January 20th date that have a cutoff date or a transaction date up through 12/31/2012. In that context, if you don't tie in here, it'll give you your discrepancies. Like one thing you want to do when the trial balance is pulled by the auditors, or if it's a review, that kind of thing, you'll want to close your books at that point so that the books can't change. And then the only thing you'll be posting after that would be journal entries. We'll go through how to close your books in a minute. I'm sure most of you are familiar with it, but we'll cover it anyway. Now, if you want the system to summarize a journal entry so you can reconcile your retained earnings, you can do that. So this will actually do the journal entry for you. So this is, in this case, we had several transactions, and this would be the journal entry that would take you to get, it would take to get your retained earnings in sync with your prior year end. So in that context, anything that hits the income statement account, you could go into 12/31/2012 and post this transaction, and then you would reverse it on 1/1/2013. If you have job cost rows in here, it'll detail the job cost with the job number and cost code. So when you journal entry it, you'll get the job cost synced in at the same time, and then you'll do a journal entry to reverse the transaction. You can do a support call, and we can explain some of this stuff too as well. So the next thing we want to do, so here we have the utilities exception results, print change report audit, your starting system date, your transactions up through date, and the summarize for journal entry to tie to your retained earnings. Okay, and these are the things that you'll put. So date, your trial balance was pulled by the CPAs at the end of the prior fiscal year. The cutoff date, which was 12/31/2012, and then the very last bottom parameter was summarized to basically give you the journal entry to tie your retained earnings out. Okay. so let's say it's January 2014. You're trying to tie out the beginning retained earnings, which means January 1st, 2013. So you'd run this report. The cutoff date would be 12/31/2012. That will get you your retained earnings tied in for the 1st of 2013. So the next step would be to make sure your trial balance balances the debits and credits, and basically we'll do that. So we go General Ledger, Trial Balance, and we say, actually we're going to go 2013 for your cutoff date. And you'll go down to the bottom and you'll make sure that this number equals this number. Now, if it doesn't equal that, if they don't equal, that means you might have a transaction that got partially posted. So let's say, you know, the system locked up, or you had a power surge or something to that effect in the middle of posting a transaction. So you might have a transaction that's partially posted. And to find that, you would go to Utilities, Exception Results, Database Exceptions, and then Database Transaction Exceptions. And this will be in the material that we have in a minute. And we click OK. And it gives us out-of-balance transactions, and there's nothing in there. And if there were out-of-balance transactions, it would itemize it for you. So here's the report you would run. Database transaction exceptions under Utilities, Exception Results for print database exceptions, database transaction exceptions, and then the GL master identifiers, you're just going to leave it at 0, which is the default. Okay. Okay, so some concepts. Let's look through some of this first. Okay, so just finish some of the concepts that lay the groundwork for the rest of the webinar. So date your trial balance was pulled by the CPAs at the end of your prior fiscal year. The trial balance they pulled out of Toolbox for the year, for the end. We've been doing the TimeSuite Toolbox concept. TimeSuite Toolbox for the end of the prior fiscal year, and we'll have a date timestamp. So what we're saying here is that if you're not sure what date they pulled their trial balance, you could call them and basically ask them what date is on the upper right-hand corner of the screen. So it would tell you right there the day they pulled the trial balance. So if you're not sure, you can just call them. Your CPA will have a copy. Okay, your CPA firm will have a copy of that trial balance in their working papers. Okay, now your CPA, another concept is that your CPA should have a copy of TimeSuite Toolbox. And if they don't have a copy, then you can just get them in contact with us, or you can probably give us their number. Call in and give us their number, might be better, and then we'll contact them and we'll get a copy put on one of their computers in their office. So they're entitled to a full running version of the software, and we'll even facilitate getting your database over to them. A cutoff date. The cutoff date would be your year-end date. Okay, so when we refer to cutoff date, it would be the year-end date. So the 2012 financials would be 2012, and then for 2013 financials, it would be 2013. So close your books. So you want to close your books for the fiscal year when the trial balance is pulled. So if you're working on 2013, you're going to close your books as of 1/1/2014 for the year ended 12/31/2013. And the way you close your books is over here under Utilities, Preferences, GL, and you'll have a valid entry date range. Okay. And so if you wanted to close the books for 2013, you'd go 01/01/14. Another concept with this is we recommend that you don't do more than 12 months on this window. For example, if I crossed over into 2014, and this is 01/01/13, a typical thing would be for us to write down 13, keep writing 13. So you might post a date as of January 10th, 2013, but what you really meant was January 10th, 2014. Okay, so that can be really confusing. We get support calls sometimes and people say, my transaction just disappeared. So it didn't disappear, it went into the prior year. So be careful with that concept. Another concept would be test of balances, and this is where a set of working papers are put together to organize and provide support for each balance sheet account and selected income statement accounts. So in the CPA process or the year-end process, either the CPA firm or maybe your internal staff would pull a set of work papers together, basically substantiating all the balances. For example, a cash account, you would pull a bank reconciliation and maybe selected pages from the bank statement to substantiate that balance. Okay, an accounts receivable balance, you would pull an aging as of the end of the fiscal year, and then you would do certain work to basically substantiate that everything on the aging is correct. And that would be a test of balances concept, and we're going to talk more about that in a little bit. So test of balances is a big term when it comes to month ends and year ends. And so one question that people pose is, how do you know your books are correct? And the answer is you don't unless you do a test of balances, set of work papers. And that gives you some sort of assurance that each of the counts that you do a test of balances on is actually correct. And so on the balance sheet concept, if I come over here, and the theory is if I take my balance sheet and I substantiate every asset I have and every liability I have, then the difference in my assets are accurate and my liabilities are accurate. The difference is my equity. Okay, so then my balance sheet would be correct. So another question that you could pose is, how do I know my income statement is correct? And the answer to that is, if you do a test of balances on your balance sheet at the beginning of the fiscal year, and then a test of balances on your, 1231. Test of balances at the beginning of your fiscal year and a test of balances at the end of your fiscal year, then your balance sheets will theoretically be correct at the beginning of the year and at the end of the year. The way a double entry system of accounting works is that the income statement captures the change in your balance sheet from the beginning of the year to the end of the year. So your equity position, your retained earnings, the difference between this number at the beginning of the year and the number at the end of the year is really your current year earnings. In fact, in our system, on your year-end financial statements, that's usually summed up. There's usually like a statement of retained earnings or statement of changes in stockholders' equity that will recap this and combine them and give you a total, and they'll just show a total. But with your in-house books, it'll show the prior year number and it'll show the current year earnings. And the combination of the two is really your retained earnings at the end of the period. So the change in your balance sheet equity is the difference between your net income for the year on your income statement. Now, sometimes some of you are closely held corporations or actually S corporations, closely held S corporations, and sometimes you'll see dividend distributions. You don't usually see dividend distributions on a closely held C corporation because those are double taxed and usually they're not declared because of that. So on an S corporation, though, it's not double taxed, so you could see distributions in here. So the change in equity from one year to the next would be the distributions and the current year earnings. Okay, and if you contributed any capital, common stock issuances, that kind of thing, those would all come into play as well. But anyway, that's the difference between the balance sheet at the beginning of the year and the end of the year, and that's how you arrive at some sort of conclusion that you've got some sort of assurance that your income statement is accurate by doing a test of balances on your balance sheet at the beginning of the year and the end of the year. So that's the test of balances concept, and that's how the CPA firms will look at it. If you're doing an audit or review, there are additional steps they'll take, analytical procedures and testing and that kind of thing, depending on the type of engagement they're doing beyond the test of balances. But the test of balances is where you start. Now, sometimes the compilations, the CPA firms are not required to like see a test of balances work papers on a compilation, but from a quality standpoint, usually firms that are are interested in making sure that everything's accurate are going to still review those test of balances work papers. On a reviewed financial statements, it's been a little bit since I practiced in public accounting, but I practiced for 18 years, and that was a big deal. On a reviewed financial statements concept, the test of balances weren't required by the CPA firm, but in my opinion, it's hard to do a thorough job if those test of balance work papers are not reviewed. So balance sheet accounts, we'll talk about the chart of accounts now. So your general ledger, if we go GL, general ledger list, all these accounts, they're referred to as an accounting term as your chart of accounts. And there are two types, two categories, two primary categories in your chart of accounts: balance sheet accounts, and those are going to be your assets, your liabilities, and your equity. And then if you draw a line right underneath that, you're going to get your income statement accounts, and that would be your revenue, direct cost, indirect cost, operating expenses, and so on and so forth. So if we look at our trial balance, we have the first section is our balance sheet accounts, and then the second section is our income statement accounts. And the income statement accounts basically are an accumulation, a running total of the amounts from the beginning of the fiscal year. So this would be the revenue from the first of the fiscal year through our cutoff date. And balance sheet accounts are balances that can be substantiated, where the income statement is a running total. The balance sheet is going to reflect something that can be substantiated. For example, the bank accounts need to have bank recs done on them, and the bank recs need to have basically no old and outstanding items on them that let's say you have a check from the prior January that's never going to clear the bank. Well, your bank rec is inaccurate by that old outstanding check because that's never going to clear your bank, so you would want to do something with that. So there are three sections. First group of numbers in your chart of accounts: the assets, liabilities, and equity. Balance sheet account is something you have or owe, or the difference between the two, which is the equity. Your income statement accounts is a second major section. These accounts are the second group of numbers in your chart of accounts. An income statement account is a running total balance since the beginning of your fiscal year. Income statement bottom line will show the change in the financial position from one year to the next. And one exception is your dividend distributions. We talked about that. So effect of misstatement on the following year income statement. So here's a concept. So let's say you have a receivable in your aging, and it says there's a $50,000 number there. And then basically you knew it was bad, you left it on there, the auditors didn't really discuss it, maybe it wasn't very old. And so that's a mistake. And so if you had a mistake, you would have a misstatement because you should have written off that $50,000, for example. Or let's say there's a $50,000 change order you actually booked and you shouldn't have, and you never got it. Let's say you didn't get any of it. That's another example of a misstatement. So if you're $50,000 overstated in like 2012, for example, what's the effect in the 2013 statements? Well, the effect will clear itself out, so the 2013 statements will be understated by 50 since the 2012 statements were overstated. So if I recognize too much income in 2012, when I end up writing that number off in 2013, my 2013 numbers are going to take a hit. Okay, so it's pushed into the following year. Any questions on these concepts so far? Okay. So we have additional concepts here. So what process will help ensure that your trial balance will tie to the prior year audited, reviewed, or compiled financial statements, and that's to close your books when the trial balance is pooled. And so you do that over here again, utilities, preferences, GL, and then close it. If we're doing 12/31/2013, make sure you put 1/1/2014. How do I know my books are accurate? Perform test of balances and produce a set of supporting work papers. And we're going to talk about those concepts in a little bit. So when you get ready for year end, so let's just make sure your books are accurate. So go through each of your accounts. Now, one thing that producing a set of work papers, I think, is probably a superior thing that you can do. And then a great start as an example. We'll go through some examples in this webinar, but a great set of examples would be for you to review the working papers that the CPA has for the prior year. Or if your organization produced those working papers, then maybe you're already familiar with what you typically look at. But let's say you're not real familiar with the working papers concept, you could call your auditor, your CPA, or CPAs, and ask them if you can get a copy of those working papers. And so they'll just have an admin person copy them all off and mail them to you. And then you can basically follow them as an example. And in that context, you can produce those set of working papers for them, and that can save you money. And every firm has different approaches and processes. But if you can sync up with them, if you're not already synced up with them, that can be a big deal. So how do I know my books are accurate? Perform test of balances and produce a set of supporting work papers. Let's see, I think we have that in there 2 times. How do I know my balance sheet is accurate? Perform test balances on each balance asset and each liability account. How do you know your income statement's accurate? You can calculate your net income using the beginning and ending balance sheets. So if I know my equity at the beginning of the year and my equity at the end of the year, the difference is going to be my net income from my income statement. You might have to factor in distributions, dividend distributions. So that's how they tie together. So here we're going to go to a tab that's labeled trial balance, and the concept is that we're going to have a trial balance, we're going to have a reference or a tick mark, a supporting work paper. So if I come over here to my trial balance, this is the concept here. So you've pulled your trial balance. Trial balance is GL and trial balance. And your cutoff date, 12/31/13, and your balances. And then you would have some sort of tick here showing the supporting work paper. So if I print out my bank rec and I copy my bank statement or copy the first couple pages of my bank statement or the first page of my bank statement, I'm going to have a set of tick marks that basically are going to support that number. So if someone looks at the balances, how do I know that's right? You've got a set of supporting work papers that basically you've produced that they're able to look at. So the B1-1A work paper would be your first bank account, and B2-1A would be your second bank account. So if we go B, we don't have an example of the working papers here, but you could have a set of work papers that would include your bank reconciliations and copies of your bank statements in their entirety or a portion of them. So one of the steps in your test of balances would be to get a bank reconciliation that ties into your trial balance. So if we look at the bank reconciliation in the system, and I think in this demo the reconciliation's January, but so we'll look at January. 2013. So your bank reconciliation is going to be something like this, with your outstanding checks itemized. Actually, we need to put that ending balance in there. Okay, so then you would have a balanced bank reconciliation. That outstanding checklist of items would be here. Outstanding checks would be here. One thing to note, we did do a bank reconciliation in the system, another version of it that will go into the TimeSuite product. And so that's accessible, so we'll illustrate that for you. So it's an editable bank statement, bank reconciliation. There's just a couple of reports that are not editable in the system. Still, in the bank reconciliation is one of them, but we do have a bank rec that is editable now. So we say print, and then the GL account to reconcile. We're going to go 10/20, starting date 1/1/2013, ending date 1/31/2013, and we can sort by different things. So this is a little bit more detailed bank reconciliation, and this is a stored procedure-driven report. So the first page, you have the same information you typically will see with the older bank reconciliation, but what's nice is on the second page it gives you your beginning bank balance, the deposits that cleared, the checks that cleared. So this is basically a recap of what your bank's going to have. If I open it in Crystal Reports, this is what it looks like. And it is stored procedure driven, so if you're taking the webinars on Crystal Reports, you'll see how that's very much facilitates modifying the bank reconciliation. All the work's kind of done for you. Validation's done for you. So your attested balances for your cash account is going to include a bank reconciliation, copies of your bank statements where the numbers in your bank rec are tied in. So for example, here's your ending bank balance. The bank statement's going to support that. You'd have a reference, a tick mark there, or reference there. And then this is going to support your balance sheet, so you'd have a reference after that. And then on your trial balance, you would have a reference like this, saying this is where the support is, so you're in your working papers, you're going to go to those numbers. Okay, so let's finish up the bank statement concepts. So you're going to get old outstanding checks and deposits off your bank rec. If you're not sure how to do that, just do a support call. We'll get somebody to guide you through that process. The organization of your work papers, B1 would be your first bank account. This is just suggested, and maybe you want to use C or AA or whatever your CPA firm uses. But the index is, this is just a sample index. And you might want to use the same index that your CPA firm uses. So if they send over a copy of the prior year working papers, the first thing you would expect to see is an index showing the organization of those work papers. So B1 would maybe be your bank reconciliation. B1A would be your bank statement, as an example. Also could be B1-1A and B1-1C, that kind of thing. B2 might be your second bank statement work papers. Other concepts, register, how do I register a check as being voided in the system? When we look at our checks, it's nice to see things in sequence. So if you want to register something as voided, go GL manual cash disbursement. There's a special void vendor And let's say 9098 was voided, so I just click next, and then it'll show up as voided in my bank rec area. Okay. Clear old outstanding checks. You do a journal entry debiting cash and crediting your expense or miscellaneous income, and then you would clear both of them off your bank reconciliation. Again, if you want more explanation or help through that, you can do a support call. So now we're going to go back to the index, or back to the trial balance, and the next item we're going to cover is our accounts receivable. So E is our set of work papers. The first thing we want a lead sheet. This is a reference into a lead sheet that we'll produce for you in the system. AR, print AR aging, and then aging to GL reconciliation. And then you might, as a suggested reference, make that your E1. Also, you will want to print your aging, and your suggested reference might be E2. For example, the first page might be E2A, E2B. So a lot of times I would put the last page first, so E2A would be the last page, E2B would be the first page, and the second to the last page would be maybe E2M. But the last page, the referencing becomes easier to look at. Let's go and do that real quick. We'll print that report in the system. I'm going to go ahead and clear out some of this stuff so it's not so, there's not so much. So GL or AR, and we go to print AR aging and then GL, aging to GL reconciliation. Now this same report is run for payables and receivables. Under accounts payable you actually have a reference into it, but you have to select AP. The default is AR, so you usually don't, when you're running it for the AR, you don't have to select AR. So what you do in this case is you say, I need the end of my prior fiscal year end, and then you'd want the end of the current fiscal year end. So 12/31/2012, 12/31/2013, and it gives me an analysis that I can use. So we have some conversion demo stuff going on here. So at the beginning of the year, you would expect to see 0, and at the end of the year, you would expect to see 0. Okay. So if I want to print my aging, I can. The blue numbers, remember, throughout the system, if you see a blue number, it's an on-demand sub-report, and then you'd be able to print this out. In this case, there's only one page, so E2 might be my aging. One thing to note on your aging is you're very interested in what's, your older items, substantiating that they need to be left on or what percentage to write off. Sometimes you'll set up an allowance for doubtful accounts, that kind of thing. So what we're looking for when you're doing your year-end is a fair presentation. So sometimes, like on the tax returns, you might be a cash basis taxpayer, or you might be an accrual basis taxpayer, or you might be a percentage completion method version of accrual taxpayer. So you might pay taxes on a different method than your financial statements or generally accepted accounting principles. And there might be timing differences even if you use the same method. So as a general rule of thumb, if you do less than $10 million in business, you're going to want to be a cash basis taxpayer as a rule of thumb. That's something to cover with your CPA. But anyway, so let's just talk about objectives of your financial statements. Sometimes companies will want their financial statements to look as good as possible and their tax returns to look as bad as possible, so they reduce their tax hit. They pay taxes on different methods of accounting, which you are allowed to do as long as your average gross receipts over the last 3 years is less than $10 million. And those are criteria you can go over with your CPA. But one thing that an organization, I think the higher quality, long-term type organizations are more interested in how did they really do. If you had a poor year, if you have a poor balance sheet, maybe, whatever the banks limit you to or the bonding companies limit you to is what you need to focus on and where you need to be. Profitability is a big deal. If you do bigger projects, you're taking on more risks. If you've had a hard time being profitable, the smaller jobs have a better margin. Cutting overhead becomes easier if your volume's lower, that kind of thing. So the concept that I like is is going after the truth, and do it for yourself, not necessarily for your bank and your bonding company and the IRS. So the truth, if you know how you did, then that's motivation. Remember the push from one year to the next. If you're trying to make your financial statements look as good as possible because you're worried about your banking or however all that lines out, whatever your misstatement is in this year, it gets pushed into the next year.
Hey, Eric.
Yeah.
So one of the things that had come up this year's the CPA sent over, their journal entries, adjusting journal entries. So I put in everything except for I told them I wasn't going to put in they do a completed contracts method, and I run the system off an accrual method. So anyway, do you see anything wrong with not booking in that? Because I told them, I said, if I book in, here I am, I'm doing the accrual and doing the at the end of December, running it to where it does those adjusts, the over and unders, and I book in the completed contracts, then a report's not going to match either direction.
Right. So what they're doing is they're trying to put your internal books on a taxing method. So a completed contract method would be something that is typically seen on the tax method. On the residential contractor, sometimes their internal books will be on a completed contract method, but even a lot of those now will be percentage completion. Unless they just do like development and they own all their projects, then it would make sense to do things on a completed contract basis. But the percentage completion method of accounting is GAAP accounting. If you follow the rules and you look at what the rules really are, it basically says you can use the percentage completion method for your financial statements and be considered GAAP as long as it's not materially different than the percentage completion method. So, but since if you're going that far to even know the difference, then you should just present it on a percentage completion method of accounting, I would think. So yeah, I would talk to them about it. I mean, obviously you're not getting into, you might have a customer base that doesn't require bonding and that kind of thing, and so if you're doing bonding, the bonding companies are going to have a fit if you keep your books on a completed contract method of accounting.
Right.
So they're generally more sophisticated than,
So what I stated to them is, okay, fine, keep the completed contract portion on the spreadsheet with your stuff, and I'm keeping my books on the accrual basis.
That's exactly what I would do. Yeah.
Okay. Thanks.
Okay, so on we talked about the reconciliation report, making sure that the lead sheet actually shows you that the aging ties into the trial balance, and we'll go through the accounts payable in a little bit and go over the concept again, and it's exactly the same for payables and receivables. And then you want to verify that the aging. So then you want to verify that everything on the aging makes sense. So if you have things that really you're not going to collect, you might want to set up an allowance for doubtful accounts. What that typically looks like on a balance sheet is this. So you have like allowance for bad debts would be right underneath your receivables, and basically what that's done is it's set up just to kind of bring that number down because maybe you've got some bad debt items. Okay, so usually your CPA firm is going to do an analysis on that, and then if you know what that analysis is, you could do it beforehand, and then you could discuss with them your conclusions, and they either push for a different number or agree with you, kind of a thing. So the CPA firm should have they're going to want to have fair financial statements, and that's what the banks want from you, something fair. The bonding companies want something fair. So, and if you're fair, then typically you're going to, over the long run, have better relationships with those guys and get more legwork out of wherever you're at. So verifying everything that makes sense, and then address the allowance for bad debts or doubtful accounts, same concept. Trace subsequent, another step that you could do is you could trace all your subsequent receipts into your aging, put some sort of check mark or tick mark, into your aging to show what's subsequently received, and you would print your AR receipts journal and do that. And the subsequent means, like if it's a December 31st, 2013 auditor review or compilation, then you're going to go January 1st, 2014 through the day the auditors are there and basically produce some sort of do the ticks, that kind of thing. And sometimes they may want their auditors to do the tick marks. So that shows what's been collected. Well, what's been collected we know is good. What's not been collected, then we don't know for sure it's good. If it's an audit, they might do confirmations where the letters will be sent out to the customers verifying that the balance is accurate, that kind of thing. Contract adjustments versus bad debt expense. So in our example before, we said there was a $50,000 item on the balance sheet, and it's not any good. And so let's say you got back charged $50,000 because one of your guys ran into a wall, and destroyed a bunch of, work that other subs had to reproduce. Okay, so the general contractor back charges you $50,000, and you don't see that on your books. So that could be to get that $50,000 off the books really means you need to do an adjustment, and it's not going to be bad debt expense. It's going to be an increase in your cost of doing the project. So you're going to debit, for example, other job costs and credit your accounts receivable, or you might do a negative invoice to other job costs rather than to revenue. That would be appropriate. Now, if you look at your bad debt expense on your in your operating section, that's a huge analytical procedure item. So you don't want to do things that are going to make you look bad in an unnecessary way. So it's important to take a look at the right way to handle some of your items and discuss with your auditors. Now, sometimes the auditors, they'll just leave what you have there. They'll do their analytical procedures, and if they're outside the norm, they're outside the norm, and if they're not, they're not. But they're going to rely on you to make those calls sometimes, and then sometimes it's up to you to bring it to their attention, that kind of thing. But there's a bad debt expense you'll typically see in your income statement, and there are a lot of analytical procedures that are typically run on the bad debt expense, and it's not necessarily favorable. So if you have a back charge that needs to come off that's in your receivables, you didn't get paid that money because the general contractor back charged you, or let's say you had a change order, you got a notice to proceed without the approval, all of a sudden you had trouble getting it approved, and so then for some amount less than the total, let's say it was a $250,000 change order, and you had to haggle with the owner or the general contractor, and you ended up only collecting 200 of it. There's a $50,000 receivable left. To get that off the books is not a bad debt expense. It would be a reduction in your contract amount. So there are different criteria you should follow in getting your change orders on your books, and that's those criteria are fairly defined in the generally accepted accounting principles world. So basically, if it's probable that you're going to be able to, if it's reoccurring, you have an existing relationship, you always get the change orders based on the normalized process, then you're allowed to put it on your books. If it's something that's questionable, if it's not probable, or maybe we should use the word highly probable, then it becomes something where you might want to factor it down to what is probable. So bad debt, what is a bad debt? Then a bad debt, getting a bad debt off the books would be where you've billed somebody, they went out of business, or they were unable to pay you, they were going to string you out for an extended period of time, you were going to have to take them to court, and let's say it's a $10,000 item and it was going to cost you $10,000 to take them to court, and you said, okay, we'll just write it off, we're not going to deal with it. Or it cost you more than $10,000 to take them to court, so then you'd have a bad debt expense. Getting an accounts receivable invoice off your books, now the auditors will do journal entries, but that doesn't take it out of your subsidiary. So if they do a journal entry, it's still going to be, the journal entry is not going to affect your subsidiary. So if you had, for example, a journal entry to get a $41,000 invoice off the books, it doesn't change it here. So one way to do it would be to go ahead and do an accounts receivable invoice, post the distribution to wherever they posted their journal entry, and your negative invoice comes in here, right? and then let's say it was a back charge that needed to get posted. So a back charge would go to the income statement cost accounts, where let's say it was a change order that got negotiated down and you didn't end up getting as much as you thought you would get. That would go to revenue. Okay. So really important to understand the differences in accounting for back charges versus accounting for contract adjustments versus accounting for bad debt expense, because those kinds of adjustments can stand out on your financial statements in a negative way. And it's important to be accurate on it too, and fair. Okay, so the next we're going to go back to our trial balance, and the next concept we're going to talk about is accounts payable. We go over to our accounts payable tab, and we have our lead sheet working papers. Our lead sheet is going to be under AP, print AP aging, aging to GL reconciliation. So the same report, except it's under the AP area, AP aging, GL, aging to GL reconciliation. Now remember, this one is the same exact report under both menu items. You have to, when you're in AP, you actually have to select it. And then the first cutoff date is going to be the end of the previous fiscal year end, and then the end of this fiscal year end. And you click it OK, and it gives you, we have the same kind of concept going with our demo database, but usually you're going to see a 0 here and a 0 here. Now if you see a non-zero here and the numbers carried over, then we've seen where people have implemented the system and several years have gone by and their implementation aging didn't tie to their implementation trial balance, and so then cleanup has to be done, and it's important to get with us, and we can get one of the consultants to help you, or you can get your CPA firm to help you with a little direction from us if that's not already, or maybe they'll know exactly what to do. But by the way, we do provide your CPA firm with unlimited tech support, so they can call us just like you can call us. You pay for the support. They're part of your group. That's how we consider it. We'll give them a free single-user version of the system so they can put it on their computers to facilitate their audit process. So we're very accommodating, and we'll work with you on it. So here we're looking for an aging and a trial balance that have a 0 difference. So here's a trade, retention, and their differences. And if you click on your numbers, it'll give on-demand sub-reports, the blue numbers for the trial balance in that case, and then the aging in this case. One thing to note on the trial balance, sometimes it's hard to tell what a control account is by looking at it. You look at it and you say, is that really a control account? And maybe you're off here. Then you look at your control accounts and they seem on, but it could be that you've got an additional control account, maybe a second AP control account that comes in here. So this is good because we do identify the control accounts here in both versions of the report for the payables and receivables. They're exactly the same reports. They just take different parameters. Also, if there are any differences between here and here, it's supposed to itemize that for you, and it typically does. And if it doesn't, you can do a support call and we'll figure out why. So other test of balances items would be to verify your accounts payable trade ties to your trial balance. We did that by looking at the report. The lead sheet identified that. Verify AP retention ties to the trial balance. So trade and retention, and then verify everything on the aging makes sense. When we go to trade and retention, we have a trade column and a retention column. And then to make sure everything makes sense, you're going to go through here and make sure, just somebody who's familiar with it's going to make sure it makes sense. You can also do tick marks on things that were subsequently paid, and then everything that's not paid you can actually vouch into your open invoice files and make sure that the open invoices tie in and agree, and make sure everything in your open invoice files that has like an invoice date up through 12/31 of your fiscal year end, or the last of your fiscal year end if you're a non-12/31 year end, make sure those are on the aging. And that's one of the CPA firm steps we would take. Let's see where we're at here. Okay, so make sure it all makes sense, and then trace your open, just like we were talking about, open invoice files into your agings, like an X tick mark, for example. Then trace your subsequent disbursements into your agings, like a check mark tick. And AP disbursements journal, would be like your subsequent disbursements journal. Let me move that down one. And then when you sort that, when you print that AP disbursements journal, you should sort by name because the aging's typically going to be by name. So I would sort it the same way so it's easy to tick it in. So you come over here, AP disbursements journal. So we're looking for the subsequent disbursements. So we would go up through whatever the date is that they pull the trial balance. And then the sort by, instead of transaction date, pick your name. So it's sorting by exactly the same order that the aging is. Now, if they want the aging sorted by job, then you'd sort this by job. Okay? So getting an accounts payable invoice off the books, consider doing a negative invoice instead of a journal entry, and then do a zero cash AP check to clear the two items. And then if you have problems with that concept, just do a support call and we'll walk you through it. That way it gets it out of your subsidiary. So when your trial balance, when your CPAs do their journal entries against items on your agings, a lot of times they'll say reverse the entry, or maybe they're used to working with QuickBooks, and so they might facilitate, they might give you information on that. Whatever they give you, just know if it affects your subsidiary, it needs to be reversed or it needs to be done directly through the subsidiary and not a journal entry. And we can help you with that process if you do a support call. Okay, so we're going to go back over here to our trial balance. And we're going to go to accrued wages. So in this case, our accrued wages are O1 work paper. So the concept is that we're going to get labor worked in 1 month, paid in the next month. So if we have a December year end, it's going to work, the labor dates are going to be in December, and the check date's going to be in January. So we want to get the liability on the books because basically owed it at the end of the year. The guys worked the days, you haven't paid them yet. It also syncs the job cost up with the general ledger. The job cost reports are all based on the work date, which is the better way to do it. The general ledger is based on the transaction date or the check date. Your job cost reports are based on the work date, so I just reiterated what we said there. That comes off the time card, and the general ledger is, all general ledger systems actually post paychecks as of the check date into the general ledger, so it syncs the two concepts up. In that context, your job cost will tie out. So here's the automated accrual, utilities, accrue wages. I'm sure most of you are familiar with that, but we'll go through it. Accrue wages. Now, once in a while, we'll come across a user that's been on the system a long time and they don't accrue wages. They're just not familiar with the process, and that will get their general ledger out of sync with their trial balance, and that's surprising sometimes that that's not taking place. And sometimes the auditors won't pick up on the fact that the system does it for them. They're not used to that. So we'll do just a cutoff date based on the demo data. So if you go post and preview, it's going to show you the lead sheet. Tells us the accrual was done on that day, the reversing entry was done for us. Gives us an itemization of the date. Sometimes this can be pages and pages. The check date, the work date was done before the cutoff date. The check date was after the cutoff date. And here's the journal entry the system posted for us. Now, sometimes our general ledger won't tie into our job cost, and one of the things we do, we'll go over to this print analysis report, payroll accrual. We can run the same report here without posting wages. So this is posting your accruals. We ran it here by posting and previewing. Here we would just be previewing. But a lot of times, if that doesn't tie in, we'll say, okay, let's see if the accrued wages were perfectly accrued at the beginning of the year. And to perfectly accrue wages is kind of a daunting task. Here we didn't have any accrued wages, and there's no journal entry here, so you're good. Here we have accrued wages, and there's a journal entry. At the bottom of that journal entry is an analysis, and the difference is 0, and we're good to go. So if there is no accrual, this is a general journal, which means it's just posting, it's just showing what the system has in it. If the accrued wages were not posted, you would get your rows here, and you would get nothing here. It would say accrued wages journal entry, and it would be blank. That would mean you didn't accrue it. You should have. To accrue wages perfectly, you've got to consider your workman's comp, general liability insurance, FICA, FUTA, SUTA, so on and so forth, union, all that stuff. And so it can be a little bit daunting to do it perfectly. In order to tie your job cost out to your general ledger, it has to be perfectly done, or you're not going to tie out perfectly. So that's a huge feature. So the print without accruing, here's your information on that. GL, number 7, print analysis reports, and then payroll accrual. Okay, let's go back over here to the trial balance. That's the extent of what we've got as far as examples of test of balances. But another thing would be a note payable. Test of balance would be producing the amortization schedule, maybe some sort of statement from the bank showing the balance, tying that in. Payroll tax payables, payroll taxes payable might be like a 941, and then tracing the last payment or two before the end of the year into the last year's check register. First couple items that got paid after the end of the year, or maybe the last item on your 941 would get paid after the end of the year, and you would trace that into your subsequent disbursements journal. And so you would log all that information so you would have some sort of feel that the payroll taxes were accurate. Notes payable, we talked about that. And then retained earnings, you'd be doing some sort of work paper that would show what maybe a copy of last year's audit, second page to the balance sheet from the audit or review, and tying it in here with some sort of tick mark. And if we look at the index, it might be like T might be a retained earnings, just as an example. W might be your job cost, job billings, and cost tie out. So let's go over to, we have couple more tabs actually. The O we talked about. G concept would be our workman's comp and general liability insurance. So let's talk about that a little bit. We go to our policies. The workman's comp, the general liability insurance can be calculated in a very similar way to the workman's comp. If you're a subcontractor, if you're a general contractor, you're going to typically pay based on revenue. Subs pay, or if you're a self-performing GC, you could be paying on subs and labor. Here's a workman's comp policy concept, and this is the typical information you'll get off of a policy. You might have the code. The code's itemized, maybe there are descriptions of a rate. You have a premium base, and then you'll have what the premium will be, the rate times the premium base. Each category will get extended, and then you'll have a subtotal. Okay, so this might be the total anticipated premium, and then you might have a discount for various discounts and various adds or premiums that you might end up with. So here we're going with negative numbers to get subtotals. Usually the subtotals are calculated off the subtotal of the number right above it, not always, but generally. And so you go through this sequence and you can get basically what you really pay. Now there's a shortcut to this in that what you do is you take, there's a formula here. What we did was we took E44 divided by E40. So we take this number and divide it by, take this number and divide it by this number, and it gives us a modifier. So with all these discounts, we end up with a 0.494 modifier. So you take your, we'll do this, 56,578, and we divide it by 59,700, and that gives us our modifier. Okay. So if I take the modifier, I can multiply each of the rates here by that modifier, and it gives me my effective rate easily. I come over here, and I bolt in my effective rate. into each of my categories. Okay. So that's going forward, so you make sure you get the right burdening numbers going forward. So anytime you change your policy, whenever you cross over from one policy to the next, you should be doing that kind of thing. And you can do a support call, and we'll help you with that. Okay. Same concept with general liability insurance if you pay based on labor. The key here is that you'll actually run some sort of report out and do an analysis on what the balance is, what the liability should be. So in the system, when you pay your workman's comp policies, you should be posting, let's see if there's an example, like Pinnacle Insurance is a Colorado concept. And you go over here and you say, okay, my payments are going to be posted in my liability account. Well, the system is going to accrue that liability every time you process payroll based on those settings over here. So if I go to GL Associations, each cost account is going to go, like if it's direct labor, it's going to get posted in here. If it's equipment, mechanical labor, it'll get posted in here. Shop labor, posted in here. And you'll notice these sections are going to, like if it's a 6,000 series, it's going to limit you to 6,000. So the burden goes to the appropriate area. 7, operating expense burden is going to go to operating expense. Direct cost burden is going to go to a direct cost expense. And in that context, we can get our burdens in the appropriate sections. Now, that's the expense side. The liability side, if I double click on this, will give me that. So whenever the debit and credit will be to increase my expense and increase my liability as I move through my payrolls and post my payrolls. And then when I go to generate my checks, I'll just post it against this 2250. So what you end up in your liability account, if we go to the 2250, okay, so you'll notice that each of the paychecks are here, where the liability for each paycheck is posted here, and then the payments we would see in here. So because every paycheck's liability is here, and every payment's negating the effect of those liabilities, you would always expect this number to be relatively close to what you really owe. Okay, so in that context, the balance is kind of maintained for you. So one big mistake would be for the payments to be posted to an expense account. Since the expense accounts are the opposite side of these entries, the expense accounts are already being hit. If I post my payment to expense, I'm going to double up my hit to expense, and then this account's going to grow out of control. So if you have liability accounts that are growing out of control, you should talk to, for example, Janine is very familiar with that. We can give you some direction on that, or your CPA firm can give you direction on that. So most of your liabilities we want to be kind of automatically maintained in the system, so you're not going to, so when you do your analysis, it should be close. Okay. So there are lots of different liability accounts, and each one of them you would expect some sort of analysis of what's accurate. Okay, from working papers on your payroll taxes. You know, if you're not sure how to do a work paper on your some sort of test of balance on your like federal unemployment, you know, you can get examples from your CPA firm. Okay, so that's the G concept to get your premium rates in there correctly in the system. So going forward, you're going to calculate and accrue the effective rates, and so your accruals are going to be accurate. If you have wrong rates in the system, you're going to accrue too much or too little. Let's go to the W work paper concept. So as an example, we use the W work papers as our job cost work papers. So direct job costs and revenues, we want that to tie out. So a report to print that shows the job cost tied to the income statement would be this reference here, and we'll go there now, go job cost, and then job cost reports, and then print billings, direct costs and burdens, and we go summary. And so, January to December, and here's our job cost by labor, material, sub-equipment, and other. Here's our income statement by our labor, material, sub-equipment, and other. And then at the bottom, we would expect to see some sort of general ledger versus job cost billing difference. The demo data, nicer when you run it for January, just to show you that you can do, the month-end concepts are very similar on your test to balance work papers. It's a little cleaner to see because it's all on one page. You have your general ledger, job cost billing differences. It should be 0 all the way across. Okay, so what are some of the differences? If you have any differences here, what are the steps that you can take? You go and you rerun your accruals for the beginning of the fiscal year, which would be, or the end of the previous fiscal year, which would be, run this as of 12/31/2012, run it again at 12/31/2013, and make sure that you have your analysis at the bottom has the zeros. If you have any differences, that means you didn't accrue wages perfectly, and in some cases you can do a support column. We can kind of give you a little bit of direction on that. If we go to job cost, summary of contracts, this direct non-job exceptions report, run it for the first of the year to the end of the year, and you say preview, and click OK. You've got your direct non-job exceptions report. And what that means is you've used, if someone uses one of these accounts for a journal entry, these direct non-job expense accounts, those are just for payroll burdens for the system to use in your payroll process. If you post anything into those accounts, your job cost can get out of sync with your general ledger, and that report basically pulls up any transactions that you posted in that context. Posted into those accounts. So quick to see what you did, and if you need a further explanation, we can explain it to you in a support call. So that's a good report for the auditors and their lead schedules. So if your job costs are off, this is what we just talked about. We want to print the aging as of the end of your prior fiscal year, print the, accrued wages as of the end of the prior fiscal year, print your accrued wages at the end of your current fiscal year, and then print your direct non-job exceptions, print your summary of contracts prior year amounts, and make sure those tie into your summary of contracts from the prior fiscal year end. That report is here, prior year amounts. And so when you start to do your current year financial statements, let's say you're a December year end and you want to do January's and February's, March's financials, but depending on when they get the audit done for you, you have to tie into that audit or reviewed financial statements, summary of contracts, in order for this to all work really well. Because the CPA's equity position is based on a certain over-under billings that comes off of those statements. So it's really important. So it says enter a date, any date in the current fiscal year, which means it's going to, if this is a December year end, under Utilities, Preferences, GL, you'll see your last month of your fiscal year end. So it's just automatically going to go back to 12/31/2012 if I put a date in 2013. So here it's analyzing what is on each of the projects that carried over. There's a whole series of steps that you go through to get your prior year end date is how the system knows it's a carryover. It'll calculate that based on this section, this of December. So if you're running the report for, if you're trying to tie into December 2012, it's going to look at the carryovers at 12/31/2012 under job cost, job list, and down here is that was where you would enter that date. A little bit outside the context of this webinar, but ties in tightly to the concepts and how everything comes together. So the month-end webinar we cover that in more depth. So other reports that can help in the year-end process, the summary contracts data to Excel. So you basically print SOC worksheet. So sometimes the CPA, you'll see the CPA firms use our summary contracts for their financial statements. But I think it can look more professional if you do it in Excel. That's how we used to do it. And this print SOC worksheet gives you all the information to download it to Excel. Also, the auditors, I'll just do 131 since that's what the demo data is geared for. In the audit process or review process, they're required to do certain analytical review steps, and one of the steps would be to analyze the jobs for subsequent billings and subsequent costs. So here, this gives you the subsequent billings, prior year costs, your burden columns, so that they can do more of their analytical procedures. So if I take and I export this to Excel, I'm going to do disk file because I'm on a Mac, and if I say application, it'll try to do it on the Mac side, and the Mac side is not accessible for me to show you. So I'm just going to go to my desktop, SOC worksheet, save it. Yes. And I'm going to go into Excel. I'll go File, Open, Desktop. And there's my SOC worksheet, the default name it gave it. This basically is Excel has a hard time with what Crystal tries to name the files, so it's not really a big deal. See, it's invalid sheet name. But now everything's in Excel. You're not going to have to pay somebody to type in all the jobs, and so they can manipulate the data around and put it in their own format. So a really helpful step. And the CPA firms that are familiar with it really like that. So they can spend their time doing the quality control for their project, and they get a good name by doing a lot of steps that are meaningful and ensure a quality auditor review, and they're not having to spend time doing a lot of what bookkeepers or sometimes controllers end up doing, where they're manipulating data in Excel. So controllers typically really like our system because they're not having to do it in Excel. So that's some of those concepts. We'll go over to miscellaneous questions, and some of the questions that have been posed in the past. Can you briefly discuss why small jobs and service jobs fall under the completed jobs area of the summary of contracts? So we'll come over here to the summary of contracts. Since the demo data is geared for January, we'll run that. We have small jobs and service jobs. They show in this section. We don't accrue over under billings on them. The readability of the financial statements is better if you segregate your small and service jobs into a separate schedule. Sometimes people will have pages and pages and pages of small jobs, and it just really clutters up the presentation if all those small jobs are grouped with your larger completed projects, and that's why we do that. So we're looking for a clean presentation, something that's meaningful to the reader, and the larger completed jobs they're interested in. The pages and pages of small jobs become meaningless, but the overall margin on those small jobs can be meaningful. Okay. So one thing to note is, accruing your over-under billings at the end of the year maybe is your typical month-end process. You would do that. A lot of times we prefer that that they didn't do that, so that when we accrued it, whatever we accrued, we could reverse. If they already posted it, we would actually do a reversing entry as of the post a reversing adjusting journal entry, and then tell them to reverse that reversing. So it got a little complicated, but so if you don't post it or you do post it, they can work around that. If they're having you post it and they're reviewing things with you and they want to get it done through the system, We see that a lot, where they'll go through and they'll do their analysis on their projects and have you adjust. You can adjust various methods, there are various methods of adjusting your projected profitability on your projects. Do it through the system. That way your over-under billings can be posted through the system. Your accrual is done. They don't have to post the entry. They don't have to have you do the reversing entry. So a couple different ways to do that. Okay, where do you set the small jobs threshold? So on the summary of contracts, we want to be able to control what is a small job. What a small job is for one company might be a different threshold for a different company. Even between years it could be different. This is where you do that: job cost, utilities, preferences, job cost, and then summary of contracts, small jobs threshold. Where can we find the material covered in this webinar to help in the help screens? Okay, well, that's a good question. So we come over here and we say help and contents, and the key is Toolbox Software year-end reconciliation process. So if we come over here, contents, bring that up again. There it is. And this year-end reconciliation process talks a lot about, it basically covers a good portion of the material we've covered in this webinar. So the webinar is geared for the same concepts. Let's talk about the release notes concept. If we click help and release notes, we're a little bit behind on filling in some of this data on our release notes. We'll probably try to catch that up. More importantly, we have reapply updates. This is where you can do a database update. Just follow the instructions here. And you can do a reports update. Whoops. Follow the instructions here. Very important to do a reports update whenever you do a database update, because a good portion of the reports are done with stored procedures. And we'll change those stored procedures periodically, and the reports will get updated. So if you ever get a report that'll flash on you, you go in and you'll pick a report, and all of a sudden it just kind of like flashes and goes away. You probably need a reports update. One typical mistake, even with our own staff on the support side, would be not to do, or they will miss the reports update when they do their database update. So if you're doing it, make sure you do both at the same time. Whoops, I think it was in Internet Explorer. The reports update can be a little more complicated because it's based on your T drive concept. Most of you have a T drive for how we do that, the TimeSuite or Toolbox or whatever you want the T to stand for. Our typical and standard installation is done that way. Sometimes we'll see people use the M drive or L drive. We try to get them to do the same thing everybody does so that our support people are not confused. But we want centralized files for your reports. If you're pointing to your C drive and the report works for you, and somebody else doesn't have the same report in their C drive, or they don't update on the C drive. So updating becomes a hassle if you don't have centralized files, and we try to avoid that. So TimeSuite Toolbox 2012 User Guide. We have a 2013. We haven't posted it, but this will give you the latest help manual. And for some reason that didn't come up. I'll have to figure that out. And then if you click on that, it doesn't come up, always let us know. We'll fix it immediately. The TimeSuite Toolbox help links, click on that. And it brings up my links. So you may have to have a Google account to bring that up. I don't know. I'm surprised to see that. So we have initiate support session. If you click on that, it'll bring you to the support where you can do that. Different things. The webinars, where the videos are starting to get posted up there on that. Importing data instructions. We do a lot of interfaces with different systems, and we have a lot of utilities now. That list keeps growing. And automated backup procedure is a big one. That's where you don't have to shut down your database engine in order to back it up. TimeSuite Toolbox client install. That's where you have a new computer and you just need the client. So we really condensed that, and it's just a couple clicks and you're done. There's a little, when you click on that, there's actually a checklist that you have to go through because you have to set up your OWC driver, and we can do that in support if you don't want to. But it gives your IT guys the ability to get things done without having to contact us. So we also do, for your IT guys, we'll do a link to all of our downloads so they don't have to, so they can do it on their own with checklists. And so we've improved some of that stuff. The videos link is there. Reapply TimeSuite Toolbox help files if we have a help file update or you want to make sure you have the latest version. And then fixes, there's sometimes people will click utilities, database backup, and it won't work. There's a 32-bit fix, there's a 64-bit fix. I think we came across a situation where the 64-bit fix, one of them didn't work and we have to adjust it a little bit. We figured out what needed to happen. I'm not sure that's posted up there. So if you have any issues, just call in. Be careful not to click 3 times in the middle of an employee. So here's just a helpful hint, because we'll do support calls. And it's kind of an awkward one, but all of a sudden they'll get one of these items will not be calculating on the checks. And what will happen is bring up the employee list, and you double click on this and you click 3 times. So it's probably about right there where I would have problems. So if I come in here, maybe I have a long list, right? I double click and it's going to bring it up. See, if I click it 3 times and I'm right there, I'm going to do that. Or right there, I'm going to do that. So people will be like, I did not change that, no way. And you know what? They didn't intentionally change it, but somebody did change it. Just be careful not to click 3 times. So just an awkward one that can happen. All right. How do I access Google Docs? www.google.com and Drive. And we'd use these webinars extensively. You can call in and you can get access to this. If I click File and Share, you'll see that it's actually just me. But if you want access to this Google Doc, just what you can do right now, if you want, you can post in, and I'll leave this screen up because we're basically done with the webinar. You can paste in your item here. You can also do a support call, and we'll give access to some of the support people know how to get access to it, and they can add you to the Google Doc so you can have access to this particular Google Doc. Okay?